first off, set the stage for us. Why do you see the broader underperformance of financials?
So I think there's a couple of questions that investors are asking. Number one is an inverted curve coming, and how do banks perform in that environment? An inverted curve, which is not what the forwards are looking for, but what the investor questions is a tougher environment for banks. So there's a little bit of angst there. And then the second thing is around credit quality, and how much do you think credit quality is going to deteriorate? We think these fears are a bit excessive relative to what we think is going to happen over the next year, and our outlook for the banks is a little bit more positive than how they've been performing recently.
Well, let's actually get to one of those areas, and that's what we see in the credit market. And so I just want to pull up the high yield versus investment grade and sort of what's been going on here. If you come inside the Bloomberg, and you can see that they haven't really been doing much, maybe some widening here or there, but overall you're still pretty tight. So where do you see the risk? How's that filter through?
Well, so the question is, will there be an even wider, spread in some of the parts of credit? In particular, my colleague Adam Richman, who covers the credit strategy for Morgan Stanley, is looking for wider spreads in both IG and high yield. Now, if you look at our models on the bank stocks, what we are expecting is over the next 2 years that credit costs will increase. And we've got something on the order of magnitude 60, 70, 80% increase in credit costs. Now, that sounds like a lot in commercial real estate and in C&I loans, but it's off an extraordinarily low base, number one. And number two, the fact that the Fed has been raising rates recently, and that's good for your NIMs. We do anticipate that we're going to see some continued revenue lift here with NIMs expanding and with loan growth beginning to accelerate.
So let's take it for the second quarter and then forward. If you take a look at, say, the earnings expectations, financials aren't at the top, right? It's industrials, it's energy, it's materials, and tech. What's your expectation for second quarter, and how does that filter through the 2019-2020?
Oh, great. Thanks so much, Alex. For second quarter, we are looking for a solid quarter. We don't think it's going to be a blowout, but we think it'll be solid. What do I mean by that? Net interest margins improving, a little bit slower pace than 1Q, but still improving given the short-term rate rise that we've had recently from the Fed. Second thing is loan growth, and this is really important because effectively, investors are very focused on loan growth. That's going to be one of the key drivers of increasing interest in the space. We do see a modest increase in overall loan growth this quarter year on year. However, importantly, what are the piece parts there? Commercial industrial loans, especially in the large banks, accelerating pretty significantly in this quarter. We're expecting, from 1% year on year last quarter to almost 3% this quarter.
Yeah.
And that will be important.